Hey traders, Parker here with another indicator, actually an update to the market rotation indicator or sector rotation indicator. I took it down from my Etsy shop because I wanted to make some more improvements, but I left that other video up. If you're looking at it now, you can see where I've made some improvements. On the top one, I made the improvements. I gave you the actual day high, the 52-week high, the day low, the 52-week low, the mid of the mid of the day, the mid of the 52-week, and the change from the previous close. You can see it matches right here on Thinkorswim. The day's average price and the 52-week average price. And RS, I changed that from RSI because I'm looking at it in its relative strength. And right now, S&P 500, in regards to its 52-week high and 52-week low ratio, is at 52%. And it looks like it's still going down. But it did have a great day yesterday. And this is the implied volatility. And that goes towards really the options. And if you look down here in the labels, you can see where it has the utilities, the healthcare, the staples, and the real estate. Those are all the defensive sectors. And then you got energy by itself. Then you go to materials, industrials, technology, consumer discretionary, retail, and finance. And those are the offensive sectors. The other ones I included was the 20-year bond ETF. And that really works with where it did have a relationship with the financial sector. When it was going down, banks was going up, and when it was going up, banks would go down. But that relationship seems to have been broken. Then you have gold, the precious metals ETF, Bitcoin. And then you have the offensive sector added together, averaged out right here, and then you have the defensive sector also averaged out and put right here. And then you have the S&P 500. You have the VIX, the volatility index, the S&P futures, NASDAQ, Dow Jones, Russell, transportation, semiconductors, communication sector, biotech sector, and you had a trend and the put call ratio. And these are all the labels, and this is a visual representation down here of what's going on or what happened. What's going on in the market of all those sectors done in a ratio where they will fit all together. And you also have on the lower indicator, you have the uptrend defense, downtrend offense, where either one is moving up or one is moving down. Then you have a divergence VIX, which saying VIX is moving up while the S&P 500 is moving down. And that's why you got downtrend SPY and you got a cross up on the actual VIX. So we're going to look to the pandemic. And right now, if we're looking down here, everything just scrunched up. And if you remember from my last video, I had to go in there and remove all that or click all those things off. So I add in a tab where we can actually cut those off. And we're going to hide the averages of each one of these and the indexes for all of those. And we're only going to be looking at the defensive, offensive, energy, and the S&P 500 because just like an onion, I want to peel the layers back. And this is everything just recalibrating. And what you're looking at right now, everything is based off the S&P 500, which I took the MACD and made it the S&P 500. And this is the average. This white and red line is the average of the S&P 500. And I'm going to take the labels off for a moment to show you, really just peel back the bottom indicator. And like I said, this is a visual representation of everything and what's going on. So the top layer is going to be the base layer for all of this is the S&P 500. So we're going to, I'm going to leave that on. So the green in the background, this green and dark green is the S&P 500, whether it's above 0 or above, where it's above 50 or below 50. it's when I say 50, I'm talking about it's a midpoint between the 52-week high and 52-week low. And the purple or magenta is the defensive sector. The blue is the offensive sector. And I put those on top of the S&P 500 to give you a visual representation of what's going on, because I'm basing everything off of the S&P 500, and I get those labels back on and explain those a little bit better too, what I added in those. But these other lines are just the averages. This red and white line is the S&P 500. If it's red, it means the S&P 500 is below its average. And I think I have it set at 21. But you can go in there, you can manipulate it and change the averages all you want. This purple line is the average for the defensive sector. This cyan line right here is the offensive sector average. And I have them all set at 21. It'll be gray if it's below, if the offensive is below the squared line versus squared line, and the triangles belongs to the, like I said, the defensive, and it'll be gray as well if it's below average. And this yellow line and yellow dotted line is the energy sector. The yellow line, the full yellow line is the actual energy sector, and you can see where it's below -40. Is actually it's actually 30 on the ratio. But for me to be able to do it on the MACD, when you put it with the below 50 being 50 being a zero line, 40 from that would get you no, it's actually 10. This is 30. I'm sorry. So this is 30, this is 10, this is 50, 70 and 90, and then so on and so forth. Above that would be 100. But that's the explanation behind this. And this dotted dash neon line is the average for the VIX, and this pink line is the VIX, the volatility index. And you can see how everything works together, and that's why I call peeling back the onion or whatever. So I'm going to remove everything else, and for everything else you do have to come down here to remove. So I'm going to remove the defensive average, defense, and offensive average, offense. I'm going to remove energy as well. As soon as I find it, my list. What out here is energy. I put it right there, energy. And let's reevaluate this. And what we're left with is the VIX and its average, and the S&P 500 and its average. And I'm coming back to the pandemic, and this is what we got right here. You can see S&P 500 was continuing making new highs in that's January, February, and then all of a sudden it fell off the cliff. Was it February 20th? And you can see right here it's matching exactly up. And right now I have this set at a simple average. So I wanted to make sure that this was working fully in correlation with the top graph. So I made sure all my averages and everything lined up. I'm just gonna make that line 3. So this is a simple average of the S&P 500, and it shows you everything. You can see right here it matches up exactly with the S&P 500 up here. You're gonna get the same readings down here. This is where it crossed above average. So everything down here matches up right here. So even if you didn't want to watch this on the S&P 500, but on another chart, you could do that, and it will match up just the same. And you're going to get these labels as well, whether it's an uptrend in defense, a downtrend in offense, divergence in the VIX, downtrend in the spine, and a VIX cross above its average. But this is all in an effort to show you market rotation. This is a visual aid for market rotation, and when possibly you can get back in. So I remember listening pre-market prep. They always talked about March during this time period being a time to get back in the market. If you're using a 21-day average, it would have been early April to actually get back into the market. And if you want the S&P if you wanted it to be back above its actual 50% from its 50% ratio of its 52-week high and low, you actually would have waited to May. I remember a lot of stocks just taking off in May, but this lines up in correlation exactly what's going on at the top. And you also, if I haven't said this, this is the same thing that's down here. It's just another visual representation. The red line is the 52-week high. The lower line is 52-week low. And then you have your 10, 30, 50, 70, 90. So we're going to bring it over to today. And the stock market had a pretty good last, 2 days or 3 days? I'm going to say the last 2 days have been pretty good. Really, with the 18th starting it off, because you had it looked like it was going to break out of this 3-day consolidation right here and go up higher, and it actually did, but it got hit in this gap and this gap. And one of the things that's happening now is the market is going down, the VIX is going up, and it's crossing above. Let me make sure I got that correct. It's crossing above 30. Not necessarily 30 on the VIX, but if you're looking at it within the RSI, like I like to look at it, the VIX is actually crossing above this parameter right here, and hopefully it doesn't cross above here, because last time it crossed above, the market took a deep dive. And this is a visual, like I said before, this is a visual representation of the market rotation. This will be your 50 line, and this will be minus 30 from 50. And this will be minus 40, so that'll give you 10 from 50. And vice versa, this will give you 20. This will give you minus 20 will get you 30. Minus 40 will give you 10, and same deal right here. So you have if you add 20, you get so if you add 20, you get 70. If you add 40, you'll get 90. And like I said, this is a visual representation of what's going on up there. So I'm gonna put the defensive and the offensive back on. I'm not going to put their averages, just the defensive and the offense. And just like I said, this is like peeling back an onion, and it's giving you that visual representation of what's going on. And I'm going to take the VIX off. So where is... There we go. All right. So now we're left with the S&P 500 is being in the background. We have our offensive sector in the foreground. And then right behind that, we have our defensive sector, which is the purple bars. And this gives you a pretty good representation of what's going on in the market. And let's bring it back to the pandemic. What we covered first. We can see when the pandemic actually happened, everybody moved into the defensive stuff. Defense kept rising, but eventually it slid down as well, and everything was below its 50 of its 52-week high and low ratio. So, but defensive after that in March, defense rose up, and it's like it took up one whole day. Even the market came up too, but most of the offensive sectors, like the tech sectors, they did not recover as fast. And that'll get me into my next thing when we go into actual market rotation and another visual aid to help us understand market rotation. So defensive rose up, defensive started taking a beat down, and offensive came up. And while the market was going up, but it all just boils down to the sector rotation in the market. But I'm gonna put the labels back on. I'm gonna take that. Take the other one off. I'm gonna move the labels down here, but you gotta wait for those to populate. All right, so let's go to utilities and see what I put in here. So you have the actual price of the utilities of $76. You have your RS, which is relative strength in regards to the its 52-week high and 52-week low. It's at the very top. It's at 91.64% of its 52-week high, 52-week low ratio. So then we come to M difference is the market difference. So the S&P 500 is what I'm considering the market. So the S&P 500 is at 52. So we can take 91 and minus the S&P 500 and what that 52, and what we're going to get is 40.67. So that's what that's really saying is 40 points above the S&P 500. So that's what M difference means on any of those labels. So it's showing the marked difference between the S&P 500, the market, that sector, and the market. So right now, utilities is 40 points above it. I think the highest one, it wasn't energy. It's one higher than that. Staples. It's basically milk, eggs, everything that you're going to keep buying, regardless of if it's a recession or anything. So Staples is actually higher than energy. And that's the marked difference. I think it's XLB. And that's the other thing you'll see on here. I didn't put the actual tickers. I actually named the sectors, what they actually are. And to verify, to make sure that I'm looking at the right thing, I can always just click on it and find Staples XLP. But after a while, you'll get pretty proficient with this after using it. And if you look at it, its relative strength matches up with the one up the top. You got, like I said, the day high. You got all this information right here. And this label, the implied volatility, be red or green. If it's above average, it'll be red. Or if it's below average, it'll be green. I have it set at 21.2. Everything I'm showing you is meant to be on a daily chart. Should be on a daily chart. You shouldn't try and use the labels or the bottom of the visual representation of the market on something like don't go to a futures like the oil and try and use this. Some of them will populate, some of them won't populate, that I found out when it comes to the labels. But I know definitely the bottom one would not work, and this is oil. But you can look right here and it's showing you the same thing. And for me, oil is probably just doing a pullback, and this line right, this broken line right here is the 50, between the 52-week high and 52-week low. And this lower part of the shaded area is the 52-week highest close. So this is the highest close on the 52-week right now. Weekly, yeah. And same thing here. This lower part is the highest close of 50. I mean, lowest close of 52 weeks in this shaded area as well. So it just gives you an area to possibly to look into a reversal or a comeback. So right now, what else I want to tell you about this? But I think I explained these pretty good. And I think I explained the lower visual aid pretty good as well. But I'm just randomly pulling up something on market rotation. You can go to this is Bing. Google Chrome takes up way too much RAM for me to have Thinkorswim on. So this is one of the reasons why I'm using Bing. But if you do market rotation, I mean, if you put in sector rotation, this is what you get, and it helps out with a visual aid with the direction where the market should be going next. And a lot of my stuff, I kind of went over here to try and figure it out. If you haven't heard of this guy or their website, try going to it, and he gives a great job of things just switching around. But we can just click on one and we can just go up to it, and this is when it's talking about the contraction. I guess this is like the market bottom. You can expect transportation to start increasing, technologies, other services, capital goods, construction industry, basic metals, energy, commodities, and then I guess once staples and defensive indices and everything start catching up to that, they'll be at the top, and that's exactly what we're seeing right now. And finances you saw what the finances is going to be down right now as well. One other thing that I wanted to show you, with these labels, they change color, and that's what I should have said beforehand. If you look at it, you have the bright green. If it's above 50 and it's above its if it's above 50, it's midline for its 52-week high and low, and it's short average is above its mid average. Then it's gonna be bright green, and yeah, the long average is 252 days for 252 weeks. 200 for a year. So 252 is the year, 21 days is the month, and 5 days the week. So that's how I set it up. So you have short average, mid average, and long average. But like I said, if it's above its 50 midpoint on between the 52-week high and 52-week low, and the short average is greater than the mid average, then it'll be bright green. And if it's below 52, if it's below its mid average between the 52-week high and 52-week low, but it's above, the short average is above its mid average, it'll be white. Just to give you a heads up to see what's going on. So retail would probably be the best example of that. But the other colors are in there. If it's this drab green color, it's because it's above 50, but it's not above its short-term average is not above its mid-term average. But like transportation, no, that's not right with transportation. But if it's above 70, but the short-term average is below the mid-term average, it'd be light green. That's whatever this is going on. Transportation is not right, so I had to go in there and go fix that. So let me explain that one more time. So if it is above 70, but its short average is not above its mid average, it'll be light green. But if it's above 50 and the short average is above the mid average, then it'll be bright green. But if it's below 70 and it's not and its short average is not above its mid average, it'll be this drab green color. And then from there, if it's below 50 and the short average is not above the mid average, you get dark green. And if it's below 30, you'll get the gray color. But if it is below 30, if it is below 50 and the short average is above the short average is above the mid average, you'll get a white bar or a white label showing that it's possibly trying to come up, or early indication, hey, there could be a turnaround. So this is pretty much it, or the end of the video. So if you want the indicator, there's going to be two options. Let's see, sector, no labels. Get rid of the labels. And there's going to be two options for the labels. You can get the MACD version or you can get the regular version. And the regular version uses basically goes from 0 to 100. And I peel back some of the other layers so you can see it as well. So you have the option of showing some of the labels or not showing the labels. You can change the actual averages to whatever you want to change them to. You have you can hide the averages like I'm about to and you can hide the other indexes like I just did. And that's going to be on both of these right here. And this is 0 to 100. 0 to 100. That representation, just like the regular RSI. And you don't have the histogram in there. You can see this green line represents the S&P 500. Whether it's moving up would be bright green, moving down be dark green. And below, like I said, you don't want to use this on something like this. You want to use it on the S&P 500 or one of the other indexes within this realm, and not necessarily one of the ones that one of the futures, because it's going to give you the information. And right now we're just waiting for it to populate. So, and like I said before, if this is below, it'll be red. So, and the other one is going to be the MACD version. And I'll peel back the layers on that one as well. And you can see the subtle differences between the two. But they're basically the same. It's just your preference of you want 0 to 100 or you want something more like the MACD to show you the difference from the 52-week from the mid 50% level between the 52-week high and 52-week low, or you just want it 0 to 100. And that's basically what you're getting right there. And that's pretty much it for the video. And this is what I've presented to you. Was the right now I was calling it the sector rotation model, but I'm probably going to call it the market rotation model. And like I said, you can look back in the past to see how everything flowed, like especially when it came to energy, how it just flowed up and it's been up. And it's still one of the top performing sectors. But in the morning time, you'll probably just want to pull this up, or the day before, take a screenshot of it and see what the numbers are and look at the differences between the two. So we can pull it back over here, and I'm going to remove I'm going to remove the bottom. And what you do with this, and really just look at it in the form of what direction is the market going in, or what direction is the stock that you possibly be playing and could be going in, if it's involved in any of these different sectors. And just, it's all about relationships. And as you can see, all the money and everything is moving into defensive, and that's why you got this defensive, uptrend defensive, downtrend offense. And you can see all this dark green. Like I said, the only one that's not dark green is going to be the materials that's in the offensive sector, because you have the materials, industrial, technology, consumer discretionary, and financial, all in the offensive. And industrials is actually up as well. So you have these two holding up the S&P 500. Tesla did pretty good, but you look over here at technology, I think it's XLK. You can see how much difference it is between the actual market. It's -10, so it's 10 points below the actual market itself in regards to the S&P 500. But this is the end of the video. If you have any questions or anything, please leave them in the comments, or you can email me at cwparker23indicators@yahoo.com. And I really appreciate you guys taking the time to watch the video, and I appreciate you the comments and everything on the other video where I said Thinkorswim indicators only. And just wanted to get my point across. Right now, I'm only making Thinkorswim indicators, but I plan on branching out to other platforms, trying to do some other indicators as well. But I really appreciate you guys, and if you haven't already, please like and subscribe, and have a great day, and happy trading.